Welcome to the human side of wealth. I'm Andrew Booza, Director of Financial Planning at RWA Wealth Partners, and your host. Thank you for tuning in. At RWA, our mission is to help you cut through the complexity and focus on what matters most, like your wealth, your family, and your future. The One Big Beautiful Bill Act is the biggest tax legislation since the 2017 Tax Cuts and Jobs Act. And most importantly, this One Big Beautiful Bill was signed into law on July 4th, 2025. So why that matters is that many prior provisions were set to expire here in 2025, but now the new law has made many of those changes permanent while adding new opportunities and challenges. In this show, we're going to cover three of the most impactful areas of this new bill: rates, deductions and credits, and finally, estate planning. And for help with that, I am very excited to welcome Chris Hernandez to the show. Chris is a tax associate on our tax team. He earned his JD from New England Law School, and he's working towards an LLM in taxation from Boston University. So he's the right guy to have alongside for this show. He's responsible for the preparation and timely filing of highly complicated federal and state tax returns, partnership returns, and tax planning for our clients. All right, thanks for being here, Chris.
My pleasure. I'm excited to dive into this with you.
All right, so let's start our conversation around the Big Beautiful Bill by talking about the foundation of the tax changes, and that's the permanent tax rates and also the standard deduction. So, Chris, what should listeners know about the rates that have been locked in by this new law?
Yeah, so the big news is that those tax brackets that were introduced back in 2017 with the Tax Cuts and Jobs Act, those are now permanently set. So we're talking rates from the bottom 10% all the way up to 37%. They're locked in. Those rates were set to expire at the end of this year. So now that we have that confirmation that they're here to stay, that is huge. And another thing is that these brackets will be adjusted each year for inflation. Mm-hmm. So the phase out range or what have you will continue to go up each year for inflation. So that's good news.
Yeah, that's an important point that you mentioned too around, there was a lot of planning and thinking around the potential sunset from the law that was passed back in 2017. But like you mentioned, these rates are here to stay. And if we spend a minute talking about the standard deduction, this is also a big deal for taxpayers, right?
Oh, absolutely. I mean, the standard deduction doubled back in 2017, mm-hmm. and the One Big Beautiful Bill makes that permanent now. So for 2025, that's $15,750 for single filers and $31,500 for those filing jointly. So that means more of your income is going to be shielded from taxation if you choose not to itemize. It's a really big deal.
That's good news, right? Hopefully for most listeners out there. Shifting gears, we won't spend a ton of time here because it's complicated. We could spend probably a whole episode on it, but the alternative minimum tax, or AMT, how does that factor into all this?
Yeah, that's a great question. I mean, the AMT is certainly a complex area, right? But the AMT exemption amounts are now permanent as well. And that's good news for many high net worth individuals. They might trigger the AMT otherwise. So having those exemption amounts come up is good news for them. So you want to think about people who have large stock options, really large investment income, like large capital gain years. This is applicable to you for the most part. And those phase out thresholds are now $500,000 for single filers and $1 million for joint filers. So big boost, high exemption amounts, and that means fewer taxpayers are just going to be caught by the AMT, which is an enigma in its own.
Yeah, I know there was I think a big sigh of relief probably for many folks that these exemptions were set as high as they are.
And
so
tax preparers and tax planners like myself, we did a big sigh of relief, right?
Yeah, I'm sure. Okay, so we've got these elements with the that sets a nice stable groundwork. If you had to zoom out from there, who do you think benefits most from these provisions?
Yeah, that's a great question. I think primarily and there's going to be a lot of studies in this in the future, I'm sure, but primarily families and individuals in that middle to upper income range, they'll benefit the most from the lower rates and bigger deductions. And, that includes the increased SALT cap, which, that is probably one of the biggest parts of the bills. But going back to the, the tax rates and the deductions, these high earners especially, strategies like income smoothing and timing of Roth conversions or timing of income, that can be powerful tools in this new environment.
Yeah, so that's great. Thank you, Chris. So we've got a nice, clear picture of the core tax framework of the bill. Let's move ahead and spend a few minutes talking about key deductions and credits. So with the big beautiful bill here, a lot of changes in these deductions and credits that directly impact families and seniors. What stands out to you as you sit back and look at this?
Yeah, I mean, talking about families, the first thing I think of is the child tax credit.
Yeah.
Right. I mean, I know you just welcomed a baby boy into the world, so that's something that's top of mind for you. But the child tax credit is permanently increased to $2,200 per child, and that income phase out remains the same, right? So $200,000 for single filers and $400,000 for joint filers. So that's a little bit more cash back in your pocket at tax time, if you apply for the credit and, if it's applicable to you. So it's a big deal.
Yeah, we'll thank our new 4-month-old, through these sleepless nights. We know that there's a tax benefit here potentially for us at the end of the year.
Right.
But all is well there. Thanks for giving him the shout out, by the way.
Yeah.
So what about the dependent care credit?
Yeah, that also got a lift, right? So before it was 35%, and now it's up to 50%. It does phase out as your income climbs, but it never goes below 35% of eligible expenses. So this makes childcare costs more manageable for families in the future, in conjunction with that child tax credit.
Mm-hmm. Mm-hmm. Now shifting to the senior deduction, spend a second talking about that too, if you could.
Yeah, so it's not quite no tax on Social Security as we might have heard in the news, right? But this one's a little different too because we have a limited window here. It's only applicable from 2025 to 2028. And it's only for taxpayers who are 65 and older. And it's $6,000 each, the deduction. So if one taxpayer is 65 and 160, that's only $6,000, but they're both over 65, right. That's up to $12,000 deduction. So that's big. That's really big. And the phase out range, that starts at $75,000 for single filers and $150,000 for joint filers. So this is a good tax planning opportunity for newly retired seniors who might have lower income years, seniors who have a lot more flexibility in establishing what their fixed income might be for that year. It's a very big tax planning opportunity to take advantage of that senior deduction. And one story I wanted to share was the gym that I go to. The owner is an older guy. I think he's in his late 70s. And he knows I'm a tax guy. And he came up to me and he says, "Chris, I'm meeting with my financial advisor. What should I tell him about this new tax bill?" And I said, "Well, look at that senior deduction." I said, "I'm not sure what your income is." And I told him the ranges, and he says, "Oh, I think we're close to that." And I said, "Yep, see what you can do with your senior deduction. See if you can get into that." I told him, try to plan your QCDs to get you in there, because he was telling me that, they just donate money out of pocket. But I told him about coupling a QCD strategy with getting into that senior deduction, and he brought it to his financial advisor, and his financial advisor was nothing short of impressed. So it's certainly, something that seniors should be very aware of, because it's for a limited time, and I think it can save them a lot of tax dollars if they apply. Yeah,
well, that's a great story, Chris. You might have to keep a secret identity out there in public, with all the questions I'm sure that you would get being a tax expert.
It comes with the territory.
Yeah, I'm sure. Okay, so finally, the SALT deduction. This has been a really hot topic. I know you and I were talking about this. We were following it closely. We followed the House version and the Senate version, and finally, what settled out. Let's talk about that for a second here.
Yeah, I mean, this is huge. like you said, we were following it. I remember going back and forth saying, "Oh, it's in the House, it's in the Senate. Is it going to stay? What's it going to be?" We thought it was going to be $20,000 up from $10,000, but what it officially is, it's $40,000 of a SALT cap. So that's state and local taxes. So think of your income tax, think of your real estate tax. It's up from $10,000 to $40,000. So that is for itemized deductions, people who take the itemized deduction. There is a phase out that taxpayers should be aware of. If your modified adjusted gross income is between $500,000 and $600,000, it drops down to $10,000 at that final $600,000 and every dollar before. So there's sort of this what's been called a tax torpedo between that $500,000 to $600,000 range for the SALT cap. And another thing that's different about the SALT cap versus the tax brackets that I was discussing earlier was that the SALT cap increases by 1% each year until 2029, and then it drops back down. So that's something to be mindful of as well. This is a game changer for people, especially in states like California, New York, Massachusetts, just to name a few states where there's high real estate taxes, high property taxes. I'm sure everybody feels like their real estate taxes are too high. But if you were capped before that $10,000, you can now take a lot more advantage of this if you fall within that income range.
That's significant bump there. Also, I love the term tax torpedo. I think we can do even more with that. Yeah. So there's a lot to consider though there, right? Especially if you're close to those income thresholds that you mentioned.
Yeah, exactly. I mean, that's why active tax planning is so crucial. So crucial. I mean, if you neglect it throughout the year and then you find out that, you're above an income range to take advantage of some of these credits or deductions and you could have been avoided, that's missing out on some good tax planning. So, you got to have active tax planning to help clients navigate these phase outs and decide when to itemize or take the standard deduction.
Yeah, I mean, as we like to say, tax planning, it's a year-round sport. I know we're close to the end of the year here. That's where a lot of tax planning occurs, but something to follow throughout the year to make sure you're on top of things. So thanks for breaking that down, Chris. So if we shift gears to the estate and gift tax planning world here as part of this new bill, this always gets a lot of attention. That's the case now more than ever here with the bill being passed. What do you feel like people need to know in this area?
Yeah, I mean, the headline here is the federal, state, and gift tax exemptions are locked in permanently. So that's $15 million a year per individual, $30 million a year for couples. And it's going to increase it for inflation every year. So that's significant breathing room for multi-generational wealth transfers, right?
Yeah, I'd say so. That's a large amount. Good excuse to review your estate plan to see if you're close to that. And like you mentioned here, as those numbers, this is just applying to the federal estate tax. So you may live in a state that has a state estate tax to be concerned with, but certainly
Seattle people beware.
Yeah. Yeah. Okay. Yeah. And what about charitable deductions? We hear there's some important updates there. We've been talking about that.
That's right. So starting in 2026, taxpayers who don't itemize can claim an above-the-line charitable deduction of $1,000 if they file single or $2,000 if they file jointly. For those who do itemize, charitable gifts are only deductible if they exceed 0.5% of adjusted gross income. And for 37% tax bracket payers, deductions are capped, so they only get a 35% tax benefit. So there's some limitations now in those charitable deductions that taxpayers need to be aware of.
Yeah, as we've talked through the details here, there's a common thread, right? A lot of opportunity, but also a lot to look out for, and good to have a professional's help alongside to figure that out. So if you had to kind of wrap this all up here, this section talking about estate and gift tax planning, where do you feel like this, where does this all go? What does it mean for clients who are considering, their estate and gift tax strategies?
It means families should revisit their trust and their gifting plans to align with these new rules. I mean, timing charitable contributions and intergenerational wealth transfers carefully will become even more important to realize certain tax benefits and preserve your legacy. So revisiting these rules, revisiting your trusts, is crucial.
Well, I think it's excellent insights as usual, Chris. So very glad we had you here on this episode. I'm sure we'll have you back for more because tax planning is such an important part of what we do here. So thank you so much for joining us, Chris.
Thank you for having me. I'm always happy to talk about tax.
So we covered a lot of detail there. We've got everything Chris and I discussed and more on our website at rwawealth.com. It's in a detailed article, as well as we have a handy roadmap that lays it all out visually for you. Give us a call at 833-RWA-PLAN. Talk to an advisor. They can email it out to you. But for now, I want to spend more time talking about the strategic opportunities for individuals, families, and business owners, and how you should be thinking about optimizing your tax situation for 2025 and beyond. For help with that, I want to welcome Steve Reeder, our president of Private Wealth, to the show. So, Steve, as president of Private Wealth here, you guide both advisors and clients through complex financial changes, just like the bill we're talking about here. So what top priorities should clients be thinking about right now under the new tax law?
Thanks, Andrew. Yes, this new tax landscape really highlights several important areas for clients to consider. First of all, it's all about clarity. We start by gathering each client's most recent tax return and running a scenario analysis. So you can think of this as a what-if scenario. If different things happen, what's the result of those? So this means that we can adjust for new rates, new deductions and credits, while evaluating SALT changes, senior deduction eligibility, and the effect of new rules for overtime tips and family credits. It also helps us test income smoothing strategies, or said another way, do we want to take taxes this year or next year? And we can be proactive about that. Like things like Roth conversions and the timing of capital gains.
And especially for families, there's really a lot to consider.
Yeah, absolutely. The new law expands opportunities that may affect families at different stages of life. We help clients update their eligibility for the expanded child tax credit and dependent care credits, and zero in on whether they or their parents can benefit from the new senior deduction. With new options like Trump child retirement accounts and enhanced 529 plans, we show families how to balance flexibility, timing, and goals so that they get the most of these changes.
That's great. And the next question here, we could probably spend an entire episode on business owners, but legislation has a lot of changes for them too, right?
Yeah, absolutely. And you're right. The business one is very complex. There's a lot to it, but just some high level thoughts on it. The QBI, or qualified business income deduction rules, are now permanent. So we review each client's eligibility, especially for those with specified service businesses. We look at timing for big business purchases and use strategies like bonus depreciation. We also make sure that the plans we recommend take into account SALT changes and other deductions so business income can be tax efficient as possible.
Yeah, I think that's a good short summary, right, of what they should be looking for. But clearly, like you said, there's a lot there, and we're happy to help for business owners out there who'd like some guidance there. So shifting to legacy planning, Chris and I talked a little bit about that, but this is obviously front and center for many high net worth families out there. What do you feel like they should be reviewing now?
Yeah, this is a big one for people that qualify for this. This is a big one. So estate and gift tax exemptions are now permanently higher. So it's set at $15 million per person or $30 million per couple, and it's indexed to inflation. Mm-hmm. We proactively review clients' estate plans, and we ensure trust, gifting, entity structures take full advantage of this, and this can make a big difference. We also can help facilitate conversations between generations so families are prepared for wealth transfers, stewardship, and philanthropic impact. And this is one that I think a lot of people miss. They're hesitant to have that conversation. Adding us into the conversation to help with the family really goes a long way.
Yeah. So we've talked about strategies for individuals, families, business owners, things to look out for from the estate planning standpoint. Last one we'll touch on here is education funding. And this is also obviously a big one for families, but what are you seeing here for clients?
Yeah, it adds some flexibility. And this is one where as even grade school costs go up, at every level we're seeing more expensive education costs. This one expands the 529 rules. It lets families withdraw up to $20,000 each year per beneficiary for K through 12 expenses. And you can now use these plans for homeschooling, therapies, and more. We help integrate 529 planning with Trump child accounts, balancing benefits, flexibility, and tax treatment to support family education goals.
Awesome. Well, thank you so much, Steve. These are practical steps that every RWA client can take as we navigate this new tax landscape. So, the team, we're here to help guide you through every step of the way. Like we mentioned, there's a lot here. So please get in touch with us if you'd like help there. So this has been a great conversation about tax planning. And one thing to keep in mind, Steve and I, we've talked about this. Tax planning is just one piece of a larger puzzle, right? The 4 pillars is an important concept that we talk about here as a firm. Now, tax is often the heart of that, right? But would love for you to shed some light on how you see the 4 pillars and tax fitting into that.
Yeah, absolutely. Taxes, we pay so much in taxes over our life that the tax planning piece is definitely a great opportunity to maximize your wealth. But as you mentioned, it's really just one piece of what we do. And I think it's extremely important that we think about all 4 of these pieces together. I often do refer to them as the 4 pillars. And I'd like to talk for a few minutes about what the 4 pillars are, why they're so important, and how they work together. So to start, every relationship that we begin starts with a great financial plan. A financial plan will bring together your finances as well as your wants and wishes, what you want your life to look like. I think one of the things that we do that's really an art as advisors is we talk to our clients or prospective clients, and we ask them what's important to them. We try to take those goals, which are oftentimes a lot less tangible than the financial goals. And we want to take those intangible goals, for example, if they want to spend more time traveling, and we turn it into a more tangible financial goal. That way we can plug it into their financial plan and understand, do they have the financial backbone to support all these goals that they're looking to accomplish in their life. But taking those intangible goals, the things that make their life better, and turning them into a reality starts with a great financial plan. Oftentimes in our industry, there's a heavy focus on investment strategy and investment management. And that's the second pillar that we want to look into. Investment management is extremely important. Making sure that we have a great investment plan for our clients is crucial to their success. But I often question, how do you develop a great investment strategy if you don't start with a great financial plan? It's really important for us to understand the financial background, what they're trying to accomplish in their life, what they want their life to look like, so that we can then build the appropriate investment strategy around that. Otherwise, we're just putting together what we think might be the best performance or return, but we need to make sure we're factoring the risk they're trying to take. How much cash flow do they need? So tying those 2 together are the first 2 pillars that we want to work with our clients with. Once we have a great financial plan in place, a wonderful investment strategy that supports their goals in life, we then want to make sure we go to tax planning. And this, as I mentioned earlier, so many people will pay more taxes in their life than any other single expense of all their expenses as they go through. But the taxes have a lot of opportunities to plan around. You have to be very intentional. So we want to understand your goals, build a strategy around it. This will then allow people to accrue and to keep the most wealth. The 4th pillar is legacy planning. So once we've determined the first 3 and we're on a great path, we've developed the wealth that we need to support our life, people often turn and think about what their legacy is going to look like. And so the 4th pillar is legacy planning or estate planning. This is really important to make sure that people get to leave behind the legacy that they want to leave. And I've heard this in so many different ways from clients. A lot of it is just values. They want to make sure they leave the right values for their children and grandchildren. Sometimes it is a financial goal. They want to support their children or grandchildren, pay for big events, weddings, education, whatever it might be. Sometimes it doesn't have anything to do with individuals. Maybe it's a cause. People want to support their charitable causes. They want to leave something behind for a cause so that they can make an impact but it is all about impact. And when you think about what a client needs to have a successful financial life, I think the 4 pillars are a great place to start. If we can focus on building a plan that works for them, getting the right investments in place, optimize their taxes, and make sure they leave the legacy behind, I think that's a pretty full financial life. And that's the target I want for everyone we work with.
Yeah, I would agree. I love the framework, and we see it in action with clients every day. I think this will be something that we focus on in future episodes for sure. But like you said, planning, investments, tax, estate, it's all part of a much larger, really comprehensive planning discussion for someone. So Steve, much appreciated. Thanks for joining us here on another episode of The Human Side of Wealth.
It's my pleasure. Thank you all for joining us today. Take care.
So when we focus on taxes as part of the big picture, the key message that I want to share with you today is that this is not business as usual. And many of these changes apply right now. So these provisions have the potential to reshape tax and wealth planning strategies this year here in 2025. So here's my advice on the next steps that you should take. If you're an RWA client, gather and review your most recent tax return and review that with your advisor. They can help walk you through different scenarios under these new rules and recommend which path forward makes the most sense for you. And specifically, we'll be exploring ways to shift your income, look closely at optimizing all the deductions that we talked about, like SALT, if you live in a high tax state, and really generally take this opportunity to refresh your estate plan as well. If you are not an RWA client, I'm very excited to offer you a complimentary tax review. Just give us a call at 833 RWA plan and ask for an advisor, or you could fill out the contact form at rwawealth.com. I'm your host, Andrew Buza. Thank you so much for joining us on another episode of The Human Side of Wealth. We'll see you next time.